Before you place your next trade, you need to hear this. Picture this. You're staring at your trading screen, watching numbers dance across candlestick charts. Your heart is pounding. The market just moved against your position, and that familiar voice in your head starts whispering. Cut your losses. No, wait it out. Maybe add to the position. The internal battle rages while your account balance begins to slip. You've felt that panic. The chart moves, and your brain whispers, do something, anything. Just don't sit there and watch your money disappear. So you click, you adjust, you chase. And somehow, despite all your analysis and preparation, you end up making the exact wrong decision at the exact wrong moment. Every trader wants control, but control is what destroys them. Today, you'll finally understand why your brain trades against you, and more importantly, how a simple coin toss strategy can outperform 80% of retail traders. Not because it's magic, not because markets are random, but because it removes the one element that destroys more trading accounts than any market crash ever could: untamed emotions. Most people think trading is about predicting the future, about reading charts, understanding fundamentals, or finding the perfect indicator. They spend thousands on courses, indicators, and systems, believing that if they just find the right strategy, success will follow. But here's the uncomfortable truth. The strategy isn't the problem. You are. The statistics don't lie. Only 1 to 4% of day traders achieve consistent profitability. 76% of retail trading accounts lose money. 40% quit within the first month. These aren't numbers from some obscure study. These are the brutal realities of an industry that promises freedom, but delivers significant financial setbacks to the vast majority who enter. Yet somewhere in the back of your mind, you believe you're different. You think your analysis is sharper, your discipline stronger, your system more refined. You're not like those other traders who blow up their accounts on emotional decisions, except you are. We all are. Because the problem isn't intelligence or knowledge, it's biology. Your brain evolved over millions of years to keep you alive in dangerous environments. When a saber-toothed tiger appeared, you didn't analyze the situation, you ran. When food was scarce, you hoarded. When the tribe faced threats, you acted on instinct, not logic. These survival mechanisms kept our ancestors alive, but they're working against you in modern markets. The moment you place a trade, ancient neural pathways activate. Your amygdala, the brain's alarm system, starts scanning for threats. A small loss triggers the same fight-or-flight response that once saved lives in the wilderness. Your prefrontal cortex, responsible for rational decision-making, gets hijacked by emotional responses designed for physical survival, not financial markets. This is why you make perfect trading plans when the markets are closed, only to abandon them the moment real money is at stake. It's why you can analyze charts flawlessly in hindsight, but freeze when live positions move against you. Your rational mind creates the plan, but your emotional brain executes the trades. Consider this scenario. You've identified a perfect setup. The risk-reward ratio is excellent. Your analysis is sound. You enter the trade with confidence. Then the market moves against you by just a few ticks. Suddenly, that confident analysis feels uncertain. What if you're wrong? What if this turns into a big loss? The fear creeps in and you close the trade early, accepting a small loss to avoid potential pain. Minutes later, the market reverses and moves exactly where your analysis predicted. You watch in frustration as what should have been a profitable trade turns into a missed opportunity. This isn't bad luck. This is your brain protecting you from perceived danger, even when that protection hurts your long-term results. Now imagine a different approach. Instead of relying on complex analysis that your emotions will inevitably sabotage, you simplify everything to its core mathematical foundation. You flip a coin, heads, you go long, tails, you go short. No analysis paralysis, no emotional attachment to being right, no ego invested in the outcome. This sounds insane to most traders. How can random entries possibly outperform careful analysis? The answer lies in expectancy mathematics and the removal of emotional decision-making. A coin toss gives you a 50% win rate over a large sample of trades. If you combine this with proper risk management, specifically a risk-reward ratio that pays you more when you win than you lose when you're wrong, the math creates consistent profitability. Let's break this down with simple numbers. You flip a coin 100 times. 50 trades win, 50 trades lose, assuming perfect probability. If you risk $1 on every losing trade but make $2 on every winning trade, your results look like this. 50 losses times $1 equals $50 lost. 50 wins times $2 equals $100 gained. Net profit, $50. This is expectancy mathematics in action. Your edge isn't predicting market direction. Your edge is mathematics combined with emotional detachment. The coin toss removes the burden of being right. It eliminates analysis paralysis. It prevents you from falling in love with positions or revenge trading after losses. But here's where most traders miss the deeper truth. The coin toss isn't really about random entries. It's about removing the psychological barriers that prevent consistent execution of any profitable system. When you accept that individual trade outcomes are essentially random, you stop fighting the market and start flowing with probability. Think about professional poker players. They don't win because they get better cards than everyone else. They win because they understand probability, manage risk, and make decisions based on mathematical expectancy rather than emotions. They can fold a strong hand when the odds don't favour them, and they can bet aggressively on weak hands when the situation is right. They separate their emotions from their decisions. Trading requires the same mental approach. Every trade is simply one data point in a larger statistical sample. Some trades will win, some will lose, but if your system has positive expectancy, you'll profit over time. The challenge is maintaining this perspective when real money's involved and your survival instincts are screaming at you to do something, anything, to avoid perceived danger. The coin toss strategy forces this perspective. When you accept that your entry is random, you can't attach ego to the outcome. You can't blame yourself for being wrong because you weren't trying to be right. You were simply executing a mathematical probability that favors your long-term success. This psychological shift is profound. Instead of viewing each trade as a test of your intelligence or analytical ability, you see it as one flip in a series of flips that will eventually produce predictable results. The pressure disappears, the emotional attachment vanishes. You become a machine executing probability rather than a human fighting for survival. But the mathematical edge is only half the equation. The other half is risk management and position sizing. Professional traders understand that how much you risk per trade determines whether you survive long enough for probability to work in your favor. Risk too much, and a normal losing streak will damage your account. Risk too little, and profits become meaningless. The optimal position size depends on your risk tolerance and the volatility of your chosen market. But the principle remains constant. Never risk more than you can afford to lose on any single trade. Never let emotions dictate your position size. Never chase losses with bigger bets. Take a breath, because what comes next might change how you see the market forever. The professional trader sits in silence. No screens flickering with alerts, no heart racing with market movements, just stillness. While amateur traders frantically click buy and sell buttons, he waits. He knows something they don't. The market isn't won by those who move fastest, it's won by those who move smartest. You see, there's a secret hiding in plain sight. The most successful traders don't trade more. They trade less. They don't predict better. They simply remove themselves from the equation. And today you're going to discover how the simplest strategy in the world can outperform 80% of retail traders who spend years perfecting their craft. But first, let me show you something that will surprise you. Professional poker players have a term called tilt. It's when emotions override logic and destroy decision-making. A player goes on tilt after a bad beat, starts making irrational bets, and burns through their entire bankroll in minutes. The same psychological phenomenon affects traders every single day. Here's what happens in your brain when a trade moves against you. Your anterior cingulate cortex detects the threat of financial loss. This triggers your amygdala to flood your system with stress hormones. Your heart rate spikes. Your breathing becomes shallow. Your prefrontal cortex, responsible for rational thinking, literally shuts down. In this state, you're not trading. You're surviving, and survival mode makes suboptimal financial decisions. The tragic irony is that the harder you try to control the market, the more it controls you. You study charts for hours, seeking patterns that will give you an edge. You backtest strategies, optimize parameters, and convince yourself that more analysis equals better results. But all this effort creates psychological attachment that sabotages your execution. Consider the trader who spends 3 hours analyzing a setup. He identifies support levels, resistance zones, and confluence factors. His analysis suggests a high probability trade with excellent risk-reward potential. He enters the position with confidence, but that confidence becomes his enemy. Because he invested so much mental energy in the analysis, he can't accept being wrong. When the trade moves against him, he doesn't cut his loss. He holds on, hoping his analysis will eventually be vindicated. The small loss becomes a big loss. The big loss becomes a major drawdown. His detailed analysis, meant to give him an edge, actually worked against him. Now imagine a different trader. She doesn't analyze anything, she flips a coin. Heads, she buys. Tails, she sells. No emotional investment in being right. No ego attached to the outcome. When the trade goes against her, she cuts it immediately because she never expected to be right in the first place. This sounds like madness to most people. How can random decisions outperform careful analysis? The answer lies in the mathematics of expectancy and the psychology of emotional detachment. Let's examine the numbers with surgical precision. If you flip a coin 1,000 times, probability dictates roughly 500 heads and 500 tails. If you risk 1 unit on every losing trade but make 2 units on every winning trade, your expectancy becomes positive. 500 losses at 1 unit each equals 500 units lost. 500 wins at 2 units each equals 1,000 units gained. Net result, 500 units of profit. But here's where it gets interesting. Most traders can't achieve this mathematical expectancy because their emotions interfere with execution. They cut winning trades short because they fear losing profits. They hold losing trades too long because they can't accept being wrong. They increase position sizes after wins because they feel invincible. They decrease position sizes after losses because they feel scared. The coin toss eliminates these emotional interferences. There's no pride in being right when your entry was random. There's no shame in being wrong. When you never claim to know the future, you become a pure executor of mathematical probability rather than a victim of psychological biases. Professional traders understand this principle intuitively. They know that individual trade outcomes are essentially random over short time periods. Markets can move in any direction for any reason at any time. Economic data can surprise. Central banks can change policy unexpectedly. Black swan events can appear without warning. What separates professionals from amateurs isn't their ability to predict these events. It's their ability to profit regardless of what happens. They do this through position sizing, risk management, and emotional detachment from individual outcomes. Think about insurance companies. They don't know which specific houses will burn down this year, but they know approximately how many will burn down based on historical data. They price their premiums to ensure profitability across their entire portfolio of policies. Individual claims are random, but the aggregate outcome is predictable. Trading with positive expectancy works the same way. You don't know which specific trades will win or lose, but you know that if you maintain proper risk-reward ratios across a large sample, you'll profit over time. The challenge is maintaining this perspective when your survival instincts are screaming at you to intervene. Here's where the psychology becomes crucial. When you accept that trading is a probability game rather than a prediction game, everything changes. You stop trying to be right and start trying to be consistent. You stop fighting the market and start flowing with mathematical certainty. But most traders can't make this mental shift because their identity is wrapped up in being smart, analytical, and correct. They need to feel like they're adding value through their insights and decisions. The idea of random entries threatens their self-image as intelligent market participants. This ego attachment is precisely what destroys them. The market doesn't care about your intelligence, your analysis, or your need to be right. It only responds to supply and demand dynamics that are often driven by emotions, algorithms, and unpredictable events. The coin toss strategy strips away the illusion of control and forces you to confront the reality of uncertainty. This confrontation is uncomfortable, but liberating. Once you accept that you can't predict short-term market movements, you can focus on what actually matters, managing risk and maintaining positive expectancy. Professional basketball players don't try to make every shot. They focus on taking high-percentage shots and playing solid defense. Professional poker players don't try to win every hand. They focus on making mathematically correct decisions based on pot odds and expected value. Successful traders operate the same way. They don't try to win every trade. They focus on maintaining their edge across a series of trades where individual outcomes are random, but aggregate results are predictable. The beauty of the coin toss approach is its simplicity. No complex indicators to learn. No fundamental analysis to master. no economic calendars to track. Just pure mathematical probability executed with robotic precision. But simplicity doesn't mean easy. The psychological challenges are immense. Your brain will rebel against random entries. It will demand reasons, justifications, and explanations. It will insist that you can do better through analysis and prediction. This internal resistance is normal and expected. Your survival instincts evolved to seek patterns and control uncertain situations. Random trading violates these deep-seated psychological needs. But your financial success depends on overriding these instincts. The key is to reframe randomness as a feature, not a bug. Random entries prevent you from developing emotional attachments to specific trades. They eliminate analysis paralysis and confirmation bias. They force you to focus on execution rather than prediction. Consider the trader who uses elaborate technical analysis to time his entries. He draws support and resistance lines, calculates Fibonacci retracements, and waits for multiple confirmations before pulling the trigger. This process creates the illusion of control and precision. But markets are dynamic systems influenced by millions of participants making decisions based on incomplete information and emotional reactions. The beautiful patterns on historical charts often break down in real time because past price action doesn't guarantee future results. The analytical trader becomes emotionally invested in his levels and patterns. When they fail, he experiences psychological pain that clouds his judgment. He starts second-guessing his system, making adjustments, and overcomplicating his approach. Meanwhile, the coin toss trader maintains emotional equilibrium. His random entries create no expectations or attachments. He simply executes his risk management rules and lets probability work in his favor over time. This psychological advantage is the real edge, not the ability to predict market direction, but the ability to maintain emotional balance while executing a mathematically sound strategy. The path forward requires a fundamental shift in perspective. You must stop viewing trading as a battle against the market and start seeing it as a collaboration with probability. You must stop trying to outsmart other participants and start focusing on outperforming your own psychological limitations. This transformation doesn't happen overnight. It requires practice, patience, and a willingness to embrace uncertainty. But once you make this mental shift, trading becomes less stressful and more profitable. The market will always be unpredictable in the short term. Individual trades will always carry risk. But mathematical expectancy combined with emotional detachment creates an unbeatable long-term edge. The question isn't whether you can predict the next market move. The question is whether you can execute a positive expectancy strategy with machine-like consistency while your emotions are pulling you in every direction. This is the real game, not predicting prices but mastering yourself. The statistics reveal something disturbing. 70% of day traders rely on technical analysis. 89% use complex indicators and systems. They study charts for hours, seeking the perfect entry signal, yet their success rates remain catastrophically low. This creates a paradox that most traders never recognize. The more they analyze, the worse they perform. The more complex their systems become, the more their accounts shrink. The harder they try to control outcomes, the more the market punishes them. But why does this happen? Why do elaborate strategies consistently underperform random chance? The answer lies in what psychologists call the complexity trap. When you invest mental energy in analysis, you create psychological ownership of the outcome. This ownership transforms objective probability into subjective attachment. You're no longer executing a system, you're defending your intelligence. Watch what happens to a trader who spends hours perfecting his analysis. He identifies multiple confluence factors. Support and resistance align perfectly. Volume confirms his bias. Every indicator points in the same direction. This isn't just a trade anymore, it's a masterpiece of analytical prowess. When this trade moves against him, he can't accept failure. His ego won't allow it. The analysis was too perfect. The setup was too obvious. He holds the losing position, adding to it, convinced that the market will eventually validate his brilliance. This psychological trap destroys more trading accounts than any market crash ever could. Now consider the coin flip trader. She has no analytical investment in the outcome. No ego attached to being right. When the trade goes wrong, she cuts it immediately because she never expected to be right in the first place. Her detachment becomes her edge. The mathematics support this counterintuitive reality. Studies of Brazilian day traders found that only 3% achieved consistent profitability, 1.1% earned above minimum wage. These traders use sophisticated analysis, complex strategies, and years of experience, yet they consistently lost to mathematical probability. Meanwhile, researchers testing random entry systems found win rates approaching 50% with proper risk management. The random entries outperformed the analytical ones because they eliminated the psychological biases that sabotage execution. This revelation challenges everything traders believe about skill and intelligence in markets. But the evidence is overwhelming. Complexity breeds failure, simplicity breeds success. The reason traces back to evolutionary psychology. Your brain evolved to find patterns in chaos, even when no patterns exist. This pattern-seeking behavior kept your ancestors alive in dangerous environments. If rustling bushes might hide a predator, better to assume threat and survive than ignore it and die. But financial markets exploit these same survival instincts against you. Your brain sees patterns in random price movements. It creates narratives to explain unpredictable events. It seeks control in fundamentally uncertain situations. These mental processes feel intelligent and analytical, but they're actually ancient survival mechanisms operating in the wrong environment. The skills that kept humans alive for millennia now destroy trading accounts with ruthless efficiency. The coin toss strategy bypasses these evolutionary traps entirely. When your entry is random, your pattern-seeking brain has nothing to analyze. When you have no prediction to defend, your ego remains uninvested. When you accept uncertainty as natural, your stress response stays calm. This psychological state enables optimal decision-making. Your prefrontal cortex maintains executive control. Your emotional centers remain balanced. Your risk management rules get executed with machine-like precision. But most traders resist this approach because it threatens their identity. They want to feel smart, analytical, and in control. The idea of random entries makes them feel like they're not adding value through their expertise and insights. This need to feel valuable through complexity is precisely what the market exploits. Professional institutions understand that retail traders will overcomplicate their approaches. They design algorithms specifically to trigger the analytical biases that lead to poor execution. High-frequency trading systems profit from your need to analyze every tick. Market makers exploit your pattern recognition by creating false signals. Institutional players use your complexity addiction to predict your behavior and trade against you. The coin toss approach makes you unpredictable to these sophisticated adversaries. Random entries can't be front-run by algorithms. Pattern recognition systems can't exploit your signals because you have no signals. You become invisible to the predatory mechanisms that destroy analytical traders. Think about this from a game theory perspective. If everyone is trying to outsmart everyone else through analysis, the advantage goes to whoever stops playing that game entirely. While others exhaust themselves seeking edge through complexity, you gain edge through simplicity. Professional poker provides the perfect analogy. Amateur players try to read every tell, analyze every bet, and find meaning in every action. They exhaust their mental resources on pattern recognition that often leads to incorrect conclusions. Professional players focus on mathematical expectancy and emotional control. They make decisions based on pot odds and position rather than complex reads. They profit not through superior analysis, but through superior psychological discipline. Trading operates identically. The players who profit consistently aren't the ones with the most sophisticated analysis. They're the ones with the most disciplined execution of mathematical edges. But here's where the psychology becomes even more crucial. Most traders intellectually understand these concepts, but can't implement them emotionally. They know they should cut losses quickly and let winners run, but their feelings override their knowledge when real money is involved. The coin toss system creates emotional alignment between knowledge and action. Since you have no analytical investment in the outcome, cutting losses feels natural rather than painful. Since you never expected to be right, being wrong doesn't trigger defensive reactions. This emotional alignment is what separates successful traders from everyone else. Not superior intelligence or analytical ability, but the capacity to act on mathematical principles even when emotions are pulling in different directions. Let me show you how this works in practice. You flip a coin and get heads, so you buy the market. Price immediately moves against you. Your analytical brain wants to analyze why. Your emotional brain wants to hold and hope. but your systematic brain simply executes the stop loss because that's what the system requires. No internal conflict, no emotional turmoil, no analytical paralysis, just clean execution of mathematical probability. This psychological state is what professionals call being in the zone. Athletes describe it as effortless performance, where training takes over and conscious thought disappears. Musicians call it flow state, where technique becomes automatic and creativity emerges naturally. Traders rarely experience this state because they're constantly fighting internal battles between analysis and execution, hope and fear, ego and mathematics. The coin toss system eliminates these conflicts by removing the source of psychological tension. When you stop trying to be right, you can start being profitable. When you stop fighting uncertainty, you can start flowing with probability. When you stop defending your intelligence, you can start trusting mathematics. This transformation doesn't happen overnight. Your analytical mind will resist random entries, your ego will demand explanations and justifications, your survival instincts will insist that analysis provides safety and control. But these psychological reactions are exactly what you need to overcome to succeed in trading. They represent the evolutionary baggage that modern markets exploit against retail participants. The path forward requires embracing what feels unnatural, accepting randomness in a brain wired for patterns, trusting mathematics over intuition, choosing simplicity over complexity. Most traders never make this transition because it requires surrendering the illusion of control that makes them feel safe and intelligent. They prefer the comfort of complex analysis to the uncertainty of mathematical probability. But comfort in trading is often the enemy of profit. The strategies that feel safest to your psychology are usually the most dangerous to your account balance. The approaches that threaten your ego often protect your capital. The coin toss system forces this uncomfortable but necessary psychological shift. It strips away the analytical security blanket and exposes you to raw probability. This exposure feels vulnerable initially, but becomes liberating once you adapt. You stop worrying about being right and start focusing on being consistent. You stop fighting the market and start collaborating with mathematics. You stop trying to predict the unpredictable and start profiting from the inevitable. The inevitable truth is that over large samples of trades, mathematical expectancy determines outcomes more than analytical accuracy. Proper risk management matters more than perfect entry timing. Emotional discipline creates more profit than intellectual brilliance. These principles apply regardless of whether your entries are random or analytical, but random entries make the principles easier to implement because they remove the psychological barriers that prevent proper execution. Consider two traders with identical risk management rules. One uses complex analysis for entries, the other flips coins. Both have positive expectancy systems that should generate profits over time. The analytical trader struggles with execution. He cuts winners short because he fears losing profits. He holds losers too long because he can't accept being wrong. He increases size after wins because he feels confident. He decreases size after losses because he feels scared. The coin toss trader executes mechanically. No emotional attachment to outcomes means no interference with risk management. Winners run to their targets, losers get cut at predetermined levels. Position sizing remains consistent regardless of recent results. Over time, the coin toss trader's superior execution generates higher returns despite using random entries. This isn't theoretical. This is the documented reality of how psychological biases destroy trading performance. The lesson isn't that analysis is worthless. The lesson is that analysis without proper psychological preparation creates more problems than it solves. Most traders would be better served by random entries than by analytical entries that they can't execute properly. But the deepest lesson goes beyond trading entirely. It's about recognizing how your mind creates suffering through the illusion of control, how your need to be right prevents you from being effective, how your analytical intelligence can become your greatest weakness in environments that reward different skills. The market doesn't care about your intelligence, your analysis, or your desperate need to be right. It only cares about one thing: whether you can execute mathematical probability with the emotional discipline of a machine. You came here believing that better analysis would make you a better trader. You leave understanding that better psychology makes you a profitable trader. The coin toss isn't about random entries. It's about random outcomes that your mind finally stops trying to control. Most traders spend years perfecting their technical skills while their psychological weaknesses destroy every advantage they build. They master chart patterns but never master their emotional patterns. They learn to read the market but never learn to read themselves. You now understand why simplicity beats complexity, why detachment beats attachment, why mathematics beats analysis. The traders who survive aren't the smartest or the most analytical. They're the ones who learn to get out of their own way. Your journey forward isn't about finding the perfect strategy. It's about becoming the type of person who can execute any positive expectancy system without psychological interference. The coin toss taught you something profound. When you stop trying to be right, you finally become profitable. The market will always be uncertain. Your emotions will always resist discipline. But now you have the framework to profit from chaos rather than be destroyed by it. Stop fighting probability. Start flowing with it. Master your mind and the market will follow.